What's up, you guys? In this video, I'm going to be breaking down CoreWeave. It has been an AI darling and had a massive run up last year before correcting massively and drawing down pretty massively over the last few months. So in this video, I'm going to be breaking down the numbers and giving you my thoughts on the business. If you like these kinds of videos, be sure to hit the like button and subscribe if you're new here. Really helps the channel out a lot. So jumping into the earnings presentation here, just going to give a quick sort of high-level view of what CoreWeave does and how they generate revenue. At its most basic level, CoreWeave is like a rent a GPU utility, while traditional cloud providers like AWS and Google offer a massive menu of general IT services from web hosting and basic storage. CoreWeave really just specializes in one thing, which is heavy duty computing power for AI and high performance computing. So their core business model involves buying tens of thousands of top tier sort of NVIDIA GPUs and then investing and spending money in building AI data centers, then renting out access to the compute to AI startups and major technology companies. As you can see here, they have a large and growing footprint of AI data centers. Looks like they have 850 megawatts of active power, 43 active data centers with 11 added just in 2025, and continuing to expand this year as well. So a couple key highlights from their full year 25 earnings. Revenue continued to accelerate pretty dramatically to 5.1 billion, representing 168% year-over-year growth. I think the main thing here that was a surprise to the upside was this revenue backlog of 66.8 billion, which was up 342% year over year. They have continued to secure large multi-year contracts with customers, but that hasn't necessarily hit the revenue line item yet, but it's a great forward indicator of future revenue and revenue growth. They spent $14.6 billion in capital expenditures. So basically, these are the investments they're making in terms of the cash they have to spend to go and buy the NVIDIA GPUs, to go and build the data centers, which they can then rent off to generate this sort of revenue. And then they generated a $3.1 billion in adjusted EBITDA, which is a 60% margin. On the surface, this looks really fantastic, but I do think like taking a look under the hood does paint a more sobering picture. A big example I think of this is when we go down and break down this adjusted EBITDA number, which I really hate for a business like this. It's an extremely misleading figure, and I do think it completely inflates the actual true profitability of a extremely capital intensive business like this. I'll break this down in a little bit. But in terms of highlights, you can't go wrong with the growth of this business. It is in an extremely hot market. Demand for AI compute is off the charts, and then we can see that as revenue continues to grow at a pretty incredible pace. And the revenue backlog is off the charts from year over year, growing 342%, like I mentioned, with most of that revenue being realized probably in the next 2 to 4 years, which is pretty incredible. Most of this new customer growth is coming from large deals with AI labs and hyperscalers customers, enterprises, and AI natives. Hopping into FactSet here for a second, I wanted to show you guys the valuation charts. So taking a look at the price to sales multiple for CoreWeave, we can see at peak, it seemed to peak at around 33 times last year's sales. And now it's compressed to 12 times last year's sales, which is still pretty steep. But obviously at 30 times, it was just a pretty unreal multiple you're paying for such a capital intensive business. Now shifting over to the next 12 months, I do think it paints a little bit more of an optimistic picture here because next 12 months, because of that huge growth in bookings, we see that there's probably going to be that indicates that revenue growth is also going to accelerate and continue to stay elevated. And as a result, the forward revenue multiple is actually trading at a decent multiple, right? So I do think a lot is going right here for CoreWeave, and I do think it remains a pretty central figure within a pretty central public market play with if you want a pure AI compute play within the public markets. I personally am not a huge fan of the business, mainly for a couple reasons regarding debt, cash burn, and just the sustainability of the business model. So the first thing I wanted to point your attention to is that misleading adjusted EBITDA number. Obviously, it looks really nice when you look at this adjusted EBITDA margin of 60%. Looks like it's just a cash cow. But then when you back up, you see, hey, like net loss has only been increasing, and they're adding back this insane amount of depreciation and amortization. And it makes sense because you're spending a lot of money on capital expenditures. Those get depreciated over the useful life of the assets in this case, but that amounts to billions of dollars being added back to your proxy free cash flow number. And I don't like this because Warren Buffett phrased it the best. Does the tooth fairy pay for depreciation and amortization? No. This add back to me is very misleading because you have to continue to spend on capex and cash needs to leave the business in order for you to continue to grow and maintain momentum. And as a result, I don't think it's fair to just be adding back this DNA number. Further, a lot of the way they're able to drive this growth and purchase these, a big way they're able to raise the cash needed to spend all this money is through debt. And as you can see, interest payments on this debt is a pretty profound amount. And so those two things combined make this adjusted EBITDA number just extremely misleading. And just to show you exactly what I mean, that adjusted EBITDA number of 60% makes you think, hey, this is a cash flowing business. Well, let's take a look at the cash flow statement. So this is CoreWeave's cash flow statement. I'm in FactSet right now, and you can see net operating cash flow is $3 billion from their business. Not too bad. Well, that's not so great because if you subtract capital expenditures, free cash flow is negative $7 billion in 1 year, which is extremely bad, right? And you might be thinking, well, hey, their cash flow from operations is pretty good. So the business operations is generating cash. But I would point to you, hey, a lot of that is just being added back from this $2.4 billion in DNA, which is a direct result of the spend here. So these two things are directly related to each other. The more you spend in capital expenditures, the more DNA you're going to have, and it just inflates this operating number. But in reality, you're just spending a ton of cash. As you can see, growth is going to remain really elevated. They're going to more than double year over year, which is really impressive. But their CapEx is also going to double. This business is going to continue to rip through cash, and I just don't see line of sight of how they're going to be generating cash for shareholders and really where the operating leverage for this business comes in. Hopping over to their balance sheet, you might be thinking, well, how are they financing all this? Like I mentioned, you can see PP&E right here of $40 billion, dollars, and that's being financed by a pretty remarkable amount of debt, right? We have $22 billion dollars in long-term debt and then $7 billion dollars in short-term debt, right? Around $30 billion dollars in total debt. And that's going to probably increase as time goes on. So overall, given the massive amounts of cash burn and unclear vision towards profitability, along with the debt that the business needs to take on to finance all of this growth, it's an easy pass for me at this stage. I don't think it's going to be going out of business anytime soon. I'm not trying to be a fear mongerer here. Nvidia needs it to survive. Microsoft is a huge partner. A lot of people invest in CoreWeave, and clearly the growth is accelerating. And so I just can't imagine that the returns here will be super compelling they start to until management starts to have a clear path towards cash flow positive, better vision on how this business is going to be able to generate cash for shareholders. And if you are interested in this business, I do think we've already seen it correct 60%. I wouldn't be surprised if this continues to decline over the next few years. It's a $40 billion business, and I do think it's kind of overvalued right now. And while I definitely think it's critical AI infrastructure, I do think that if you wanted exposure to the space, Amazon's probably a better risk-adjusted bet, given that you have a extremely profitable underlying business in AWS and their retail business. Amazon is spending $200 billion in CapEx to go and build out AI data centers and own the market there. From that perspective, here's a business where you're getting a lot for one stock. And I do think the risk adjusted bet is a lot more attractive in Amazon. So, in case you're still interested in the space, Amazon could be an alternative for you. Anyway, that wraps up this video's discussion on CoreWeave. If you enjoyed the video, be sure to like and subscribe if you're new here. And let me know down in the comments what company I should be digging into next. Thanks, and catch you in the next one.